Welcome to a summary of our annual report, summarizing the past and advising on the future within shipping equities. First of all, the coronavirus is currently dominating every newspaper headline, and the shipping shares are falling a lot. Could you please explain what is going on?
Well, it seems like shipping was impacted by yet another black swan event. So the impact is, I would say, still a bit early to assess correctly. And to be honest, I'm an econometrician. I don't have the kind of capacity to say how this is going to play out. But what I do see is that we will, or it's impacting already. So we will have short-term implications for the economy. We do see the Chinese holidays being extended. So what we think will happen in the short term is that less economic activity. That's obviously bad for shipping. And then potentially a multiplication effect from people drawing on their inventories rather than ordering new supplies. So for instance, coal, iron ore, oil inventories in China could be drawn upon rather than being consumed. So that's kind of the near-term effects. However, we have already seen that Chinese authorities have started to stimulate the economy. So that's something they did that with the SARS, and they do it now. So that's something that could be positive in the medium term. And also in the medium term, we could have a positive effect from the restocking of the inventories. So potentially this could happen at the same time as we have a seasonal uptick in Q3, Q4. But again, it's too early to say right now. But looking at the share prices, I think investors are pricing in obviously the tangible near-term implications, but also a lot of risk for the future. That said, with a one-year horizon, I think current levels could be, at least could turn out to be a great opportunity to buy.
Okay. That is very interesting. So with the strong fundamental view on shipping that you have previously stated, could you please elaborate on this and maybe give us the highlights of the different segments?
Sure. So let's start with LPG shipping. The share price index for VLGCs is up a whopping 194% year over year. That's actually not too far away from our forecast. But still, the year started on a slightly softer note. But we had 32% of the forecast newbuilding deliveries coming now in January. So I think the main supply growth is, or at least a large portion of the supply growth is behind us, and that kind of explains some of the weakness in January. Additionally, we had the change from high sulfur to low sulfur fuel oil, which also contributed to that time charter equivalent rate going down. But now we're back in around $60,000 a day. And keep in mind that these vessels, they have a cash break even around $20,000 a day. So we think this could peak potentially around $80,000 a day in April. And we do also see the immense possibility or immense the potential for cash distributions to shareholders in 2020. Looking further afield, I think 2020 might be the peak of this market, but we do still see spot rates and earning tapering off slowly. So at least in our forecast period until 2023, we do see earnings averaging above mid-cycle earnings for the coming years. So that's still very good and still supports shares going forward. So I think for the LPG sector and the VLGCs, I think our top pick is Avance, but BV LPG and Dorian LPG also potential good buys in current market. Moving on to LNG shipping, 2019 obviously disappointed our expectations, but they were quite high going into the year. I think 2020 will be another good year, potentially even better than 2019 and 18, and significantly better than the average of the last, let's say, 5 years. But then after 2020, we do see limited demand growth and high supply growth. So I think 2021, 2022 could be weak years. And then it all comes down to whether the order book is growing too much or not. So it takes about 2 years to build a ship. From 2023, we see good demand growth. So key thing to watch is the order book, and we do have enough demand growth for a significant number of vessels, but we will have to keep an eye to see if it grows too fast with speculative new buildings. But potentially we could have a big surge again from 2023. That said, I think the market is currently pricing in the future weakness already, and we are quite positive towards Flex LNG, which is priced at a 50% discount to net asset values, and it has basically a brand new fleet with the best technology. So I don't see any reason why you should have discount when the alternative cost is going to yard and buying ethanol. Okay, dry bulk. We had the tragic dam collapse in Brazil last year. We kind of threw all forecasts up in the air in a blink of an eye. When we landed, we kind of had a tough first half, but then in September we saw spot rates in dry bulk at 9-year highs. So it was kind of maybe one of the most volatile years in recent history. We did downgrade the sector in November as we saw the potential for earnings to come from 9-year highs and down to operational cost levels again. And that's basically what has happened. So we also actually downgraded to underweight in early January because we didn't see that share prices reflected that negativity we had expected. But now share prices have fallen some 20-25% on average, maybe. So that's why we upgrade to buy again. So we haven't basically changed our target prices since early January. Not that much since November either. But the fact that share prices have come down now, and also we see asset prices having fallen a lot, that's a cause for upgrade in our book. And the last shipping segment I wanted to touch upon is the oil tankers. Demand in 2019 was even stronger than we had expected, and refineries were kind of gearing up for the IMO 2020. So we saw a prolonged refinery maintenance season in the first half, but very shallow one in the second half, all as expected. Share prices did, though, outperform our model. So we had forecasted a lot of upside, but it went even further. So in our mind, once we entered 2020, we kind of saw flattish development for share prices in the short term. We did expect spot rates to come down as they have, and we expect them to stay low until the winter market commences around October. We do, however, expect them to be slightly higher than the usual spot rates in the low season because of higher demand, and also the scrubber vessels are earning more. But we did not foresee the coronavirus, so I think that's kind of the main reason why share prices are this low. And I also think that were a lot of investors that were investing at the highs in fourth quarter last year, which kind of maybe not that familiar with seasonality of spot rates. And they kind of maybe pushed share prices higher than our model would otherwise suggest, and that I think also is have a reversal effect this quarter. But based on our asset price forecast and forecast of spot rates being continuously better in this decade than the last few years, I think oil tankers are in a very good position to earn a lot of money and pay out good dividends, and also they have good support from net asset values. So I personally think current share prices is an opportunity to buy. And our top picks are ADS crude carriers, and Sako's energy navigation and TK tankers. It's at least the latter two are highly leveraged, so it's a high risk as well.
Okay. Well, thank you so much for that rundown. But if you had to choose just 3 top picks, what would they be?
So always a tough question,
Yes.
but
the viewers want it.
I think ADS, as I just mentioned, is a topic. It has a scrubber installed. It's a vintage fleet, so you kind of get the highest elasticity towards asset price changes, and they have a very good cash distribution policy. So I think it would be a good bet. Starbulk also scrubber installations there, so you could have a good protection from the current low earnings environment. And you also have the great upside, which we think will happen in dry bulk over 1 year and 2 year time horizon. And lastly, I think Avance Gas is a good bet on the LPG shipping segment. Okay,
great. Any last comments before we wrap up?
I think the coronavirus is kind of top or a hot topic these days, and I think it adds a lot of uncertainties, and it's really impacting shipping shares. But I think it's important to remember that the fundamentals in shipping, they look good. Nothing has changed there yet, besides the very near-term implications of the lower trade. So I think it's up to each investor to kind of manage that particular risk for him or herself. Yeah. But from our point of view, I think current share prices offer a great opportunity to enter shipping space for the long-term investor.
Okay, thank you for that summary, Joakim. And remember, if you want more information, you can find the full report at our website, cleaves.no. Thank you for watching.